Hello everyone, welcome back to Zotio Trader. So today in this series of episode, we're going to talk about price action. We're going to drill down the very basic of technical analysis. We're going to teach, we're going to give trading tips for newbie traders. So hopefully, in this series of videos, you'll be able to learn something, and you can start avoiding mistakes because many traders tend to make big mistake when they make money. They make small money, but when they make mistakes, they tend to make terrible mistakes, and these are the reason the number one reasons why these people are broke. So here, let's talk about the very basic things that you should do and things that you're not supposed to do. So um, like first of all, things to remember before enter in stock market. Now, several things that you should do, as for every disciplined trader should do, even though it would be difficult, but you have to ask yourself every single day because some days when you're trading, like when the market is against you, you tend to lose your patience, and sometimes you have different things that could happen in your life. It's difficult to keep your emotion calm. So always remember these rules, and every day you should do a like a self-checking to see if you actually are doing great when it comes to all these emotional things. Okay, first would be control your emotion, treat like a robot, always follow your discipline and money management. So we're going to talk about more in the future episode about how to specifically control emotion. It would be quite difficult, but there are tips, there are methods that you can follow to achieve that. When you are trades when you are trading small amount of money, you tend to be a lot calmer. But if you're trading large portion, if you are trading like heavy positions that you are, for example, trading other people's money, or maybe you're using leverage, or maybe you're trading via borrow money, you tend to lose your cool. Okay, so there are different scenarios, but you should always follow your discipline. Many traders have different discipline, and in future we're gonna cover that as well. But you do well remember you need to have a money management. You cannot every time you bet 100% of your money and turn everything into a gamble. That is not trading. That is pure gambling. Without proper money management system, trading could be gambling, like right out the back. So I highly recommend you to remember the first point. Okay, so the second point is always use 30% amount in stock market. So this ratio wise, it could vary depending on how much money that you trade. But let's say if you're trading like less than, like maybe $5,000, and you start to and you want to build a maybe a stock portfolio, it would be really difficult to use that 30% out of $5,000. That means you only have $1,500, and you need to find stocks that are cheap. And the stocks that are cheap, they are cheap for a reason. So it would be difficult for you to make any money out of it. So I guess if you start applying these rules, you need to have at least 10K or 20K dollar in your trading account. Okay, so third would be enter the stock at the best entry time. So in the future, we're going to use and going to introduce and explain how, and you'll be able to capture a good timing for your trades. Four, you always book profit. This is what a lot of people done wrong. Like these people make huge bets, they make money, but then when in the next time they feel like they're kind of trading guru, that they feel like luck is on their side, and they started using a leverage, and then they end up losing everything. So if you're a trader and you trade for a living, you do remember always book your profit, because if you're a trader and you keep winning for some time, your ego will start getting bigger and you will get the best of you, and you end up betting everything and you lose all the profit, and then you cannot survive with that trading account. So always do remember to book your profits. Okay, the fifth point would be you need to follow strict stop losses. So there are stop losses for reasons, okay? Because it's all coming down for your money management skill. Stop loss for a newbie trader is a must have, because it actually forces you to think twice before you place your trade. But when you're getting good at it, you can tend to have different type of stop loss. You can have conditional stop loss. You can use options to hedge and etc. Not necessarily for you to only use stop loss as your risk management skill, but for fundamental, like for newbie trader, you better start with a strict stop loss. Okay, so that's the case. The sixth point would be always follow the market trend. Okay, so while many would think that they'd be able to anticipate the market pivot, but that's not always the case. When you first begin trading, what you need to trade, it's instead of placing all these difficult black swan trade, what you want to do is you want to trade those short market trends, or the obvious market trend that you can follow, right? You don't always have that kind of volatility on daily basis, but when that easy market trend coming, you jump right on. That would be how you trade. Okay, so 7 points. Forget all the news, always trade on your setup. So what would be your setup? Your setup, it would be a very difficult or complicated term for a trader, because a setup means mindset. A setup means your fundamental analysis, your rationale, the reason why you place your trade. There are checklists that you're put it in a little boxes, those factors that are driving you to place a trade. So like news could happen all the time, but then you need to do your homework and start with a solid with a solid analyst. Without a solid analyst or solid analysis, your trade will end up, like causing a lot of cost. So that you don't want that to happen, because news can prove to be disruptive. Okay, so number 8 would be do not follow any crowd decisions. Okay, so when you're in the market, it is difficult for you not to listen your friends, for example, your relatives, people around you, and people don't necessarily have done homework. So, stock market is like this. Everyone could have their opinion, but if you allow, like, your crowd decision or other people's opinion got the best of you, you better not trade. Okay, so the last would be to practice your strategy on daily basis, learn new things from time to time. As a trader, you cannot expect to only trade one single product and remain profitable all the time and all day long, and that it's almost impossible. So view trading career as part of serious career. You need to learn, you need to constantly learning stuff to become a trader. A lot of people think that, okay, to become a trader must be very free. You don't have a boss to listen to. You don't need to submit any kind of daily task. So if you trade on your own behalf and manage your retirement account, must be a good one. But in reality, if you're a trader, you need more discipline, because nobody is going to force you. Okay, so that means on daily basis you have to, turn on your computer, look for trades. You have to check the market setup, check the volatility on daily basis, and most of the time you need to plan your trade and you need to execute those trades. So it's like any other jobs on this planet, it is still a job. So for anyone who has kind of unrealistic thought that if you become a trader and you work at home, you don't need discipline. It's better for you to stop trading and change to another career. That is words of wisdom. So thank you. And if you are doing that, that's going to jeopardize your account. You are not going to have good time. Okay, so here we move on. So there are different terms for you to learn in order to be a good trader. So there are different jargons. For example, long means buy. If you're a long stock A, that means you're buying stock A. If you're short stock A, that means you're selling stock A. Okay, so you have bull. It could mean you have a lot of buyers, or it could mean like the market it's in a bull sentiment. That means the market has a very strong upward power. A lot of people are buying, so that underlying assets price keep going up. And bears, that would be the opposite. That means there are a lot of participants are selling the stocks, and you have enormous selling power. You have enormously downward power. So that means bear. And you have bullish. Bullish, that means the market has an uptrend. Bearish means market has downtrend. And risk reward ratio, for example, 1 to 3. What is risk to reward ratio? That means on each amount of risk that you take, the amount of the reward that you get. Okay, so 1 to 3 risk reward ratio, that actually means you're taking 1 unit of risk, but you are getting 3 units of rewards. In the future, we're going to talk about how do you be able to differentiate the different trading opportunity and how to recognize their risk to reward ratio structure. So that be the case. So there are several points of price action that you should know. Okay, so price action represents collective human behavior. So it's self-enforcing because people are looking at the charts just like you. So, proficient traders and professional traders, they are going to follow the different patterns. They're going to make similar decision. It's responsive, so it's self-reinforcing. So that's why trading could be viewed as a sort of collective human behavior, because people look at, for example, breakthrough. People look at the fake breakout. They say it's not time to buy. Maybe it's time to sell. When they start seeing these signals, peoples are, with the big money are doing, like what they can. So it's going to be a collective behavior. Okay, so the price action strategy allows you kind of predict the next movement. Of course, you cannot always accurately predict the next movement, but the whole point of predicting is not to predict that you think you have 100% of success. The reason why you still try to predict the market is that by doing so, you will have different plans, you will have different scenarios that you can follow. What if situation A happened? What do I do? So what if situation B happened? Then what do I do? So predicting the next movements and make scenario analysis is always good when you're trading, when you're making the next trade. Okay, so the price action strategy also helps a trader to reduce noise and false signal. So there will be a lot of signals because there are just literally millions of indicators out there. There are so many different, technical analysis framework that you may end up using. That is the most complicated thing. Like, I mean, most of the forex traders and stock traders, they keep losing money because they kept all these kept to go to all these gurus and ended up learning all these fake signals, or they don't know how to differentiate noise from those trading signals that really matter. So they end up studying all these fake patterns, and therefore they make very poor judgments. That's why they lost a lot. They lose a lot of money. Okay, so and then smaller time frame all have too much noise and also book loss many times. Okay, so meaning please do avoid overtrade because a lot of people they trade too much or maybe they trade too often and they are just being too greedy because they think every day there will be market volatility every day. That is the wrong idea. Like most of the time as a trader, you want to be patient and expect a great volatility to kick in, and that's the time where you make money. That's the time where you make the hunt. So think about this: a tiger, or maybe like a lion, when they are pursuing those animals, they are always patiently waiting for the right time to strike. Okay, you don't see lions running around randomly with random rabbits. It would just consume all your energy. Okay, it doesn't matter if the lion is strong or not, simply because the lion is being too stupid pursuing that rabbits all day long. The lion is going to be exhausted, and in the sense the trading account is going to blow up. Guy's going to lose everything. So larger time frame have reduced noise and give exact entry and trade signal. That is accurate because like a lot of people they want to get rich quick and they don't have a lot of money. That's why they start a very small trading account. They probably start $500 to $1,000 trading account, and they start trading all these stupidly leverage product, for example, like CFD. So they could use very small amount of money to trade very huge leverage. So guess what's happening? That's going to eat up all your capital because you have such an insignificant amount of capital that it's not able to confront any risk or whatsoever. So any small volatility of the market could could results in losing the 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 principal money that you throw in the account. So that's how a lot of brokers are making money out of your losses because they know you want to get rich quick. You use smaller time frame, you use smaller contract, you have smaller account, but yet you are using insanely leverage. There's only one ending for you, which is blow up your own account. That's it. Okay. So chart time is very important in price action. So basically, price action provides you a proper timing tool that you can follow, and it also provides a framework that you'll be able to comprehend the charts and you'll be able to time your trades accordingly. So price action system is proved to be useful and very powerful. So price action is applicable to any market like commodities, currency, forex, etc. So what is price? So price, the very definition of the price is it depends upon supply demand. So if demand is more, you have price increase. People want it more, right? So you have fewer supply, the price go up. And if you have an oversupply situation, you have too much of the goods, that becomes less valuable. That's why the price will fall. And when price are falling, people seeing this fall, there'll be more people selling this. So you have support level and resistance level. And in the next episode, we're going to introduce how do you draw a support level and how do you draw a resistance level. It's very important when you start trading. Uh, it's it's the very fundamental that you have to master before you start trading your account and throw your money away. Okay, so when market going up means the demands go up. So when market going down means the supply got more, the supply has increased. So that's why the price is going down. So what is price action strategy include? It includes support and resistance level. So it also includes candlestick chart pattern. A candlestick is very important. Okay, so in the future episode, we're going to introduce you the very key concept of candlestick, because by understanding the details of candlestick, it helps you to understand the small details of the market volatility and movements. For that, those little movements that gives you very strong signal to make financial decision accordingly. So you also a price action strategy also has a reversal point. It means that a certain it for these reversal points, it tells you when the market has a turnover. Okay, for example, when the market is going long for some time, and all of a sudden the market is going down, and you have to capture a reversal point. If you cannot capture that point, you will also lose, you end up losing the money that you made previously. So the price action also help us to identify the reversal, the pivot point. Okay, so red candlestick, red candle means bearish candlestick, means price open at high and close up to low. And green candle means bullish candlestick, means price open at lower and closed up high. So unlike line charts only gives you a point. That means you have no idea of the price movements on intraday basis. All right, because we have like the market starts at 10 and close at around 4, so it's quite some time. When you look at the market, because you have such a long time, the price will have certain volatility. The price would fluctuate. So you want to know the opening price and closing price on daily basis. You cannot go and find the line charts, because the line charts is simply dots and line that doesn't show you all the detail. However, the candlestick is more powerful because the candlestick shows you, for example, this square and this line, it shows you have an opening price, you have a closing price. So you have a high close, you have an open low. So you have a high open, you have a close low. That means high close means you have a close the market with a higher price, but when the market's open, it trades a low, it trades from a relatively low price. That means the daily market is going up. So that's why it's a green candlestick. And from high open means from the opening price, you have a higher prices. So by the time when the market is closed, you end up having a lower price. That means the market intraday wise has been dropping ever since. That's why the candlestick results in the red. So you have high and close, low and open. Okay, so you have high close, low open. You have high and open and low. Okay, so that's the case because by the time when market close, maybe it doesn't hit this place, so that's why it's only a line. Okay, so you don't really see a lot of price, would say liquidity right here. And you have a high and close, you have open and low. Okay, so meaning the price is starting, it hits very low price, but end up when the market is closed, it closes at a very high price. And as you can see here, it doesn't have many volatility or value. It doesn't have much volume here, so it end up like a straight line. So it doesn't have any volume here. That's why you have a square right here. You have a square right here. So by having a straight line, that means the market only hits certain price once or twice, and that's it. You don't see price coming down repeatedly. You don't see price hitting towards this level repeatedly. That's why they use the straight line to represent the movement. Okay, but without the square, that means the price has no volume. So you have bullish candlestick and bearish candlestick. So the red one, being the bullish candlestick, it higher opens higher and close. You have like low and close. Okay, so you have bearish candlestick. The green one is the bullish candlestick. The red one would be the bearish candlestick. So you have an opening price with a higher price. You have a closing price with much lower price. That means the market has gone down significantly. So when you look at this square, you have high, open, you have low, close. Okay, you have a close and low, you have open, you have high. Okay, so high and open still is the similar to the above candle chart, the bullish chart. It doesn't have any volume here, so that's why the square end up right on the downside. So it doesn't have any like like volume right here, so you end up seeing the closing price right here on the upper square. So in today's episode, we talk about the very basic fundamental of price action and what the advantage of price action to help you to build down a solid fundamental for your trade. So if you like the content, please subscribe and click that like button for me. And also you can join our international trading community. I'll try to upload as much as I can. Trying to upload entire series. So I cannot simply finish this without your help. So help me if like please support me. In that way I can upload more meaningful videos for you guys. So thank you guys for watching. I will see you in the next one. Goodbye.